Hello, Accounting 101 students. In this video, we are going to go over some accounts receivable and notes receivable transactions with question number 6 in our Chapter 8 end of chapter practice exercises. So in this problem, we have Buffalo Industries that closes its books on its July 31st year end. So one of the things that you want to highlight or note is the year end of July 31st, and the company does not make entries to accrue for interest except at its year end. So on July 31st, we should record our entries for our interest receivable and interest revenue. And on June 30th, the notes receivable balance is $25,800. And our notes receivable balance includes these three notes. So we have a note for $6,000, $7,800, and $12,000, and all of these added together equal our $25,800 in our notes receivable balance. So in July, we have some transactions that were completed, and the first part of our problem involves journalizing the July transactions and the July 31st adjusting entry for the accrued interest receivable. So we're going to go ahead and go through each of these journal entries, and I'm going to be scrolling down so that way you guys can see the rest of this problem. On July 5th, the company made sales of $4,440 on Buffalo Industries credit cards. So this is the company's own credit cards. So we need to record accounts receivable, and because we've made sales, we need to record our sales revenue. And for the journal entry, you're going to just include the amount that is given to you in your problem. So I'm going to debit my accounts receivable and credit my sales revenue for $4,440. On July 14th, the company made sales of $700 on Visa credit cards. And Visa is charging a credit card service charge of 6%. So in this case, the company receives cash when they have generated their sales revenue of $700. However, the amount of cash that they receive is going to be less because they have to pay a service charge expense to Visa. So you're going to take the amount of the credit card transaction, which in this case is going to be 700 times 0.06. And in your calculator, you'll want to compute this expense. So it will be $42. So your debit, so you'll remember that all of your expenses are going to be a debit, it's going to be $42. And the amount of cash is going to be what's remaining. It'll be the $700, the amount of the sale, minus the $42 service charge. So that will be $658 in this example. So in your problem, you'll include our dollar amounts. Next, we're going to record our journal entries on July 20th and July 24th. And in both of these two journal entries, the company received payment in full on the amount due. So remember how we have these three notes receivable amounts. Now we're going to receive the cash that is due from these three parties. So what you'll want to do is you'll want to note that when we receive payment, we're going to record a debit to cash And we're also going to record a credit to our notes receivable because we're going to receive the full amount of the note. In this example, the amount that is due from Coot Inc. is $6,000. So I'm going to include that full $6,000. And that $6,000 will also be received in cash at the same time. The other thing that we want to realize is that the company needs to record the interest revenue for the period for which they have earned interest. And in this problem, we were told that the company does not record their interest except for at year end. So we want to make sure that we include the interest for the full term of the note, because this note started on April 21st and ended on July 20th. That is before our year-end date of July 31st. So we're going to compute the interest revenue that was earned during that period. So our interest will be computed by taking 6,000 times the interest percentage of 0.07 times 90 over 360 days. And you'll remember that for our interest calculation, we're going to use 360 days rather than 365 days because of the bank holidays. So you'll end up with $105 for your interest. So your interest revenue will be including a credit for $105. And so the total cash received will be $6,105. And our next transaction will be fairly similar. So our next transaction is going to be on July 24th. And on July 24th, we're going to go ahead and record a debit to cash because we're going to receive payment in full from Brady Company. We're going to record a credit to our notes receivable for the amount of the note, which is $7,800. And similarly, we're going to be recording our interest revenue that we have earned. And when I look at the date of the note, this note was issued on May 25th, and our date of July 24th is before our year end. So I need to compute interest for the full period of this note. So I'm going to take $7,800 times the interest rate in this problem is 11% times 60 over 360 days. So my interest amount is going to be $143. And so in my problem, in my interest revenue, I'm going to include 143, and then the cash received is going to include the notes receivable that I'm going to get paid back and the interest that was earned during that period. So we're going to go ahead and note that both of these notes, this Coot note and this Brady note, were both paid in full. So the very last transaction that we have on July 31st is going to be for the remaining note. So we need to record one more transaction for that remaining note. And we're going to go ahead and include that in our journal entries as well. So we have July 31st, That's our year-end date. We're going to be recording the accrual of interest, so interest receivable and interest revenue, which is earned. And we're going to compute our interest by taking the $12,000 times our interest rate of 0.06 times, and we're just going to include 1 month out of the 12 months. The reason why we're including 1 month out of 12 months is that the date of this is June 30th, and we're recording our journal entry as of July 31st. So only 1 month has passed out of the 6 months. So you always want to look at the time period of the note. So you're going to include in your interest revenue and your interest receivable for your $60 in your journal entry. All right. So I'm going to go ahead and scroll down so you guys can see the rest of these journal entries. So now you can see all of the journal entries that we've recorded during the period. If you want to pause the video just to make sure that you have all of the dollar amounts included in your problem. So the next part of this problem is entering in the receivables accounts and posting the entries. And you're going to fill in the information in your T accounts. We started off this problem given our balance for notes receivable of $25,800. We noticed that we had 2 transactions in which our notes receivable was paid in full. So you can see that the amount that you're crediting is coming from these 2 journal entries. And we also had an accounts receivable that was received in that first transaction. So go back to the first journal entry for this dollar amount. And then we have our interest amount that we are recording as our interest receivable on the remaining notes receivable. Then the next part of our problem is to include in our ending balances into our balance sheet. So this is a partial balance sheet. It's only showing the receivables accounts as of or at July 31st. So within our current assets, we're going to include notes receivable, accounts receivable, and interest receivable. So these numbers are going to be your ending numbers from the T accounts that we just updated. And you're going to compute the amount of total receivables. Thank you for taking the time to watch this video.